Adobe is trading for $572 a share, so if you wanted to buy 100 shares, you'd have to pony up $57,200. But what if there was a way to control 100 shares of Adobe for only $96? I'm Seth Freudberg, the head trader of S&B Capital's options trading desk here in Manhattan, and the traders on our desk here have a full understanding of how options work, how to trade them, and more importantly, how not to trade them. So while the idea of controlling 100 shares of Adobe for $96 may sound like an awesome idea, in this video we'll show you the fallacy in that concept and hopefully save you a lot of money in the process. So stick around so that you can be a smarter trader and not get suckered into dopey concepts that have hidden flaws. Hi, I'm Seth Freudberg and I'm the head trader of S&B Capital's options trading desk. S&B Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. Now, I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really very valuable. Okay, so this is going to be a pretty blunt video today because there are certain, frankly, dopey concepts floating around in the trading world, and I feel an obligation now and then to debunk them because we try to keep it real here at S&B Capital, and it annoys me to honestly see people get sucked into new and different ways to lose your money, and I think that it's important to be educated as to how to stay away from these get-rich-quick schemes in the options world, because short of just hitting the lottery, in the real world of trading, you have to actually work to become competent and consistently profitable, and you just can't get around that. You see, a lot of people are attracted to options trading because they don't really have enough money to buy 100 shares of a stock like Adobe, which I understand completely because everyone has to start trading with whatever capital they have. But they have heard options are really cheap, and you can somehow control 100 shares of a stock way cheaper with options than you can outright buying the shares. So they want to know more about options. Now, in order to explain why there's a huge flaw in thinking this way, I need to make sure that you understand how call options on stocks work. For those of you familiar with call options, just hang in there. This is going to be really quick, and then we'll jump back into the lesson of this video really fast. Okay, so what's known as a call option on a stock entitles the buyer of that option to purchase 100 shares of a stock that at a certain price called the strike price of that option, regardless of what price the stock's trading at. The buyer of a call option pays what's called a premium to the seller of the option because the seller of the option is taking the risk that the stock will go way above the strike price of his call option, in which case the buyer can exercise his option and the seller could lose money on the transaction because he'll have to sell the shares to you for far less than the value they're showing in his account. But it's important to realize that if the stock on the expiration day of the call option is not above the strike price of the call, then the seller of that call just pockets the premium that he was given by the buyer. He walks away completely free of any obligations because no one would exercise the right to buy a stock at a price higher than is trading in the open market. And so in a nutshell, that's how call options work. So you'll very often hear individual traders say, gee, I love trading options because the most I can lose is the cost of the option, which I've heard are really cheap. Whereas with shares of stock, I can lose way more than that because I'm putting so much more money up. And they say to themselves, just think about the leverage I'm employing here, how smart I am. Because if I spend a little bit of money on the option and the stock goes above my call strike price by expiration day, then I could get a return of 1,000% or more. And that's theoretically true. For instance, let's say that we thought Adobe stock was going to go up over 600 by mid-July for whatever reason. But suppose with the stock trading at 572, we don't have a spare $57,200 to spend on 100 shares, but we do have $96. Well then, we could spend $96 by buying a 635 Adobe call expiring on July 16th. And what that means is that on July 16th, if Adobe has rallied to above 635 to say 646, that call would be worth a lot of money because we could buy those shares at $6.35 and immediately turn around and sell them for $6.46 in the market, making $11 per share, as you can see from the calculation, because you'd be buying the shares for $6.35, the strike price of your call, but you could sell them for $6.46 immediately. And so you'd make $11 on each share, times 100 shares, because each options contract represents 100 shares of stock, cashing it in for a total of $1,100. And then if you deduct the original cost of the option, you'll see that the net profit on the trade is $1,004, which when compared to the original $96, does indeed produce a return of over 1,000% in a very short period of time, less than a month. Before we get into why there's a giant fallacy in this whole discussion of buying cheap options to make huge returns, I'd like to let you know that there really are real and effective option strategies. And if you want to learn 3 legitimate option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, or the options income strategy that allows you to make consistent money whether the market goes up, down, or sideways, and how to make money on a stock or index trade even if you're outright wrong on the direction, click the link that should be appearing now at the top right corner of your screen. That will open the free workshop registration page in a new window, so don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com. Believe me, you don't want to miss this, so pause this video, sign up now, and then resume watching. Getting back to our Adobe example, you may be wondering, hey, this sounds great. I mean, I put up $96 and I make over 1,000% return on that small investment in a very short period of time. So what could be wrong with this? I'm living the dream, right? But there's a problem with that thinking. And the problem goes like this. You see, when somebody says to you, the most I can lose is the cost of the option, what they're really saying to you is, the most I can lose is 100% of my investment, because the cost of the option is your investment. So if somebody said to you, the most I can lose is 100% of my investment, that wouldn't sound so great. But that, in fact, is exactly what you're being told when someone says the most you can lose is the cost of the option, as though it's not a big deal to lose 100% of what you put into the trade. But the fact is that most people who buy cheap options are exposing themselves to losing 100% of their investment. And to make matters worse, the probability of this happening, losing 100% of his investment, is extremely high, over 90% in most cases when you're referring to cheap options. So let's take a look back at this Adobe example that we were just discussing. But this time, we're going to focus on something else. Not the cheap price of the option, but rather the crucial issue of the probability of that cheap $96 option having any value at all on the day that it expires, which is July 16th in this case. So if you look at the column called delta on this options chain, you'll see that the option has what is known as a delta of 6.09. Now, an option's delta is arrived at through a mathematical formula which projects how much the option's value will change with a 1-point move in the stock from which it's derived. But a delta has also been shown to approximate the probability that an option will have a value on the day it expires. In other words, the probability that Adobe will get past that call's $6.35 strike price by the time these options expire. And so what this means is that, as a rule of thumb, there is a 6.04% likelihood that the option will have any value at all on the day it expires. And so, putting it more realistically, it has a 94% chance of expiring completely and utterly worthless on the day it expires, because the chances of Adobe closing below $6.35 on that day are actually super high, meaning you just burned up $96 in a game that you should have known going in had a 94% chance of being a losing proposition. And so if you do the math, if you do that exact same trade over and over again, you will lose 15 out of 16 times. And that's because the probability is so high of that call expiring worthless. So what this means is that if you do this trade 16 times in a row, the overwhelming likelihood is that you will lose almost every single one of those times. And so therefore, if you made this equivalent trade 16 times, The losses on those 15 trades would be $1,440, meaning that just to break even and make no money, but at least not lose anything, you'd need to make $1,440 on that one winning trade, meaning the stock price would have to go way past the strike price of the call on that 1 out of 16 times, and that's only to break even, mind you. And if you do the math on that, you'd need to have a 1,500% return on that one winning trade just to break even. That's the hurdle that you have to overcome on that one trade just to break even. Otherwise, the whole thing has been a fiasco. Doesn't sound so great now, does it, under the light of honest scrutiny? In other words, what this means is that even if right out of the blocks I make 1,000% return on a long way out of the money cheap call trade like this, the likelihood is I'll give it all back and more if I continuously make an equivalent trade the next 15 times. Because there's such a high probability that I'll lose the trade in the first place. So next time that someone brags to you about 1,000% gain on an out-of-the-money call option, the next question should be, well, tell me, how many times have you lost money making that same trade? And at that point, they're pretty likely to change the subject. So remember, when someone says to you, all I can lose is the cost of the option, that's like saying, all I can lose is everything. And to make the experience even more pleasurable, you'll lose 100% of your investment 94% of the time. That's what these guys are bragging about, and it makes no sense. And that's because they leave out the probabilities when they're telling you their one anecdotal big win. So to me, it's pretty much a losing proposition. Now, selling those same options where you would win at 94% of the time, that sounds like something a little more interesting to me. And that approach, being net sellers of what is known as options time premium, is the kind of trading that we practice on our desk. And that's a completely different sort of story for another day. Now, just to remind you, if you're serious about your trading, you'll need to check out the free intensive options class that we're currently running, where you'll learn 3 real-world option strategies that our professional options traders use all the time. So just click the link that should be appearing now at the top right corner of your screen, or you can just head on over to optionsclass.com to register for this free workshop directly. It really is a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now before you miss it.